Good morning, guys. We are going to wait 2 minutes more. Maybe someone is trying to connecting now. So I'm going to give another 2 minutes to start. In progress. Okay, guys, let's start. Good morning. I'm glad to see you again, Don. So welcome to this class, Leticia. I haven't had the opportunity to have a class with you, but welcome to this class. So let's start. But before to start, I would like to know more about you, Leticia, because I talked with Don and he explained me some of his background. So I would like to hear you, Leticia. Please, could you tell me what is your job? What if you have a previous knowledge about investment analysis? What are your likes and dislikes? I would like to know more about your background. This is very important for me because if knowledge let me know if I need to give the class a very basic or a little more advanced. So could you tell us more about you, Leticia, please? Where are you from? Please.
Hi there, can you hear me?
Yes, of course. Yes.
Right, I will not turn on my camera because I just woke up because where I live it's 7 in the morning, so I don't think you need to see me.
No worries.
Right, so I work in health and social care. And I'm studying, of course, with the London School of Business. So yeah, I work in health and social care. I'm from Brazil, but at the moment I'm living in the Falkland Islands. Before I was living in Scotland. So yeah, I started studying. I was reading a lot about business, investment too. So yeah.
Okay, Leticia. So I'm glad to hear that you are from Brazil because I'm from Mexico. So
oh, nice.
yes. So at the end we are Latin American people. So I'm very happy for that. So
good.
Additionally, I'm going to ask you a secret question. Okay.
Right.
What is your favorite holiday or tradition?
Right. My favorite holiday. Well, always is Scotland.
Okay.
That's my
Okay.
favorite. Yeah, holiday.
Holiday. Great. Okay, so welcome to this class. This class is
Thank
called
you.
and it's called an investment analysis. And welcome again, Dawn. So let's start.
Right. Thank you.
If you have any doubts, please just let me know.
Right.
Share. Okay. Okay. I write here my name. I'm Yuriko, but you can call me Yuri, Yuriko. Both are good. This is an overview of this class. This class could be, sorry, this class could be at 10 and 12. We are going to review 6 topics, and the lectures will be like on average 2 classes, but I feel that this module is so big, so probably we are going to need 1 extra class. Let's see if we can finish in 2 sessions. If we need more time, we can add another class. We have a break of 10 minutes after 1 hour of class, and the evaluation would be 1 presentation and 1 report for 4,500 words both. And the weight is 50% the presentation, 50% of the report, but it doesn't mean that the presentation needs to be 2,250 words. You can balance the words of every evaluation. These are the rules. I would like that you participate in the class. And if you don't understand something, please let me know. And additionally, I'm going to send this presentation to the school, and the school probably will send you, is the most important thing. And this is a guide that could help you to study and to know more about topics. So this is our calendar. These are the topics, and basically these are the time in which we are going to develop every topic. Today we are going to review the first 3 topics. Every topic I hope to cover in 40 minutes, but obviously it's not mandatory. We can extend more this time. And okay, so now we are going to review the topic number 1, in which we are going to understand basic concepts in investment analysis, including different types of securities. Which are these concepts? We are going to learn what is an investment and what are the benefits of the investment. We are going to discuss the concept of investment analysis and portfolio management, and we are going to discuss what are the difference and why they complement each other. Additionally, we are going to discuss passive and active investment. We are going to explain the different kinds of securities. Maybe you have heard the word securities, but we are going to go deeply in this concept. And finally, we will discuss the characteristics of each type of security. Okay, so Why an investment is important? Basically, investment is when we have some money and we decide to put in some financial instruments or in some places in order to generate an additional money. So we can have, for example, a money that we don't need to maybe we have money and we don't have, for example, something to buy, and it's important to move the money. So for that reason, there is some securities in which we can invest. So basically, one benefit of the investment is the construction of wealth and growth. Because in terms of investment, we can go, for example, with a manager that knows about investment, and this manager could find a way in which we can have an additional money. So depending on of capacity of saving, depending on the risk that we decide to take. So one of the benefits is that we can construct more wealth. Another thing is fighting against inflation, because as you know, if we have money and we have money in one place, the inflation is increasing. And maybe if now I can buy, I don't know, a car with this money, in the future, I don't know if this money would be enough to buy the car, because obviously the price is increasing all the time. So investment helps to fight against inflation. And normally when we invest in something, we receive a percentage bigger than the inflation. So at the end, our money is moving. Another benefit is the reduction in taxes, because most of the governments in the countries give some benefits, not only to the people, but also to the companies, if they have some investment in terms of maybe the reduction of taxes. So on one hand, we have more money if our money is invested in some securities or in some places. And additionally, this money increase because we can have tax reductions. The third benefit of the investment is that we can reach goals and objectives. Maybe we don't need the money right now, but maybe in the future we want to buy a house probably, and a wise way to reach this goal is maybe investing our money now to create an additional weight, an additional money with the interest, for example, and in the future be able to buy this house. So another benefit of the investment is that we can reach goals and objectives if we talk about a person, but if we talk about companies, for example, if the company wants to grow, is a very wise way if the company invests its money, because the company could reach additional money with the investment. And 5 is cash flows even when there are no earnings, for example, imagine a company this year, the 2020, that it was a terrible year because of the COVID situation, and most of the companies didn't have earnings. So if the companies created a plan to invest, it doesn't matter that 2020 was a bad year, because at the end, the money of the company is moving, and probably they didn't receive the same amount of money, of the same amount of earnings, but at the end, this company that have investment, they earn money, probably not because of the core of the company, but because of investment. So investment helps to have extra money, even in bad years. And in what can we invest? So basically, we can invest in three types of investment. We can invest in a stock investment. It means that the person that invests is the owner of a proportion of a company. We are going to explain this this type of investment in detail in the presentation, but basically, stock investments mean that we are the owner of one proportion of the company. Also, we can invest in bonds. Bonds is the same as a loan. We can, for example, lend our money to a company and we can receive the interest of this loan. So this is other type of investment. And the third type of investment is cash equivalents. Cash equivalents are more liquid, and their purpose is short term, and include, for example, money market instruments, for example, certificates of deposit on commercial paper. It means if we have extra money and we don't want an extra risk, and we want to invest in a short term, maybe cash equivalents could be very beneficial for us. And this graphic contains the three types of investment: stocks, bonds, and cash equivalents. Another thing that I was thinking about cash and cash equivalents, we can invest, for example, in dollars or in pounds, or we can invest, for example, we can buy a gold, a bar of gold. These are cash equivalents. And now that we know more about what is an investment and what are the types of investment, we are going to discuss what is investment analysis. Basically, investment analysis is a method to evaluate investment opportunities. Maybe if we use this method, this investment analysis, maybe at the beginning we could think, I want to invest in cash and cash equivalents, but through investment analysis we can find that probably this is not the most profitable option. Maybe the best option for us is invest in cash equivalents. So through investment analysis, we can have this conclusion: what is the option that is beneficial according to our capacities, our risk, our income. So basically, investment analysis is a method to evaluate investment opportunities. And additionally, it helps if an option or if an investment is worth it or not. You know, as I explained, maybe at the beginning we can think that invest in a stock, but then we can find that the option that is more beneficial is another kind of investment. And investment analysis implies a variety of approaches. Because through investment analysis, we can study different business sectors, maybe economic and economic trends too, because obviously other business sectors are changing and economic trends too. For example, now a technology sector is very profitable because of all these kind of developments in technology, and probably other sectors, for example, I don't know, maybe food in 2020, again with the COVID situation, was not profitable because a lot of restaurants had to close because of the situation for the COVID. And so maybe in 2020, the sector that offered more was the sector that was more attractive was technology and not a sector related to food or services. So investment analysis help us to know what are the trends according to economic situation, and obviously economic situation move the business sectors. And investment analysis implies to track in the past to evaluate the possible future and determine the combination of investment that we can do. So this is another important point about investment analysis, that it tracks in the past to predict the future. Advantage and disadvantage of investment analysis. As everything in the world, investment analysis has advantage and disadvantage. I have in this slide the most important advantages, but we can have more than this. Number one, that investment analysis helps investors to make wise decision about their money. Because as I told you, investment analysis is not only take decision according to the capacity or according to the profile of the investor, is more than that. Is investment analysis, as in the previous slide, could help us to know the trends in the world. Other advantage is make investors more alert about market trends and investment plans. When the investor or the manager that is managing the investment could find a better good option, and for that is important that this option needs to be taken, because all the manager all the time is in alert status to find opportunities or to find some possible risk in the investment. Another benefit is that while doing analysis, the expert can easily reach the securities and can also evaluate the sustainability and the growth of the near nature. So through this study, the investor can have a clear idea of the securities he wishes to invest in. So it's not the same that we have in our mind invest in some financial instrument but in this case, if we use the investment analysis, we can discover if we want to invest in this financial instrument or not, because maybe the investment could sound very attractive, but then we can discover that it's not very attractive, no, through investment analysis. And another advantage is that not only individuals or people can invest, can use the investment analysis. Investment analysis is very important for big companies too, and to arrange their portfolio management. We are going to explain what is the portfolio management. So, but keep in mind that investment analysis is not only for individuals, it's also very important for big, small, medium-sized companies. But we have some disadvantage. For example, it requires investment plans, and sometimes is complicated overall in terms of big companies, because obviously if we have a very big company, the manager needs to be very detailed, or needs to be very careful to create a strategy of investment. And other disadvantage is that it requires knowledge, and sometimes risk-aware investor appoint expert for the same. Normally, probably we can invest in a very basic investment, but if we can invest in some instrument more detailed or more specific, we need to have a person that guides you to invest, because investment analysis is not easy and it requires a certain level of knowledge of the market. Another disadvantage is when an individual is trying to have financial planning, he should determine the market risk, which is not predictable. Market risk is obviously we can probably have a strategy, but at the end, market risk is difficult to predict. It's difficult to track. So for that reason, market is risky, but it doesn't mean that we say, I know, because of the market is very risky, I'm not going to invest. It's difficult to determine the market risk, but for that reason, there are some managers and some person that can help us to invest and to decrease this market risk, even when market risk is not predictable 100%. Government is a factor that is not considering when we invest. And for example, if we invest in some government instrument, or if we invest in some projects, sometimes problems in governments or changes in the policy of the countries could affect our investment, and this is not a factor. This is a factor that is not considering when we invest. This is the disadvantages, but personally, I feel that we have more advantages than disadvantages, you know, because if we have money, it's very wise to don't keep our money like in the past in our houses. No, the thing is that I feel that we need to create we need to know that investment is very beneficial, and investment is the only solution to move our money, and is the only solution because the money doesn't lose value. Okay, till here, do you have any doubt or any comments? If you have some comments or doubts, please let me know. Okay, now, what is a portfolio management? Till this slide, we have explained what is investment, what are the benefits, what is invest, and the different types of investment, and what is investment analysis. But other important concept to understand in this lecture is what is portfolio management. Basically, portfolio management is the ability of selecting and overseeing or supervising a group of investments that meet the long-term financial objectives and risk tolerance of a client, a company, or an institution. So portfolio management is the combination of different kind of securities. So one difference that we can find between investment analysis and portfolio, you can see my screen? Okay. So one difference that we can find in portfolio management and investment analysis is that investment analysis is a method to evaluate one security in only one, but let me check. Okay, sorry. Don, I haven't seen your question. When is the right time to make an investment? Can people with a small saving invest? But I think that yes, can people with a small saving can invest? Yes, people with a small saving can invest. For example, if you have extra money and you don't want to have to take a very high risk, you can invest, for example, in treasury bills or in investment or in financial instruments that are emitted by the government, because it requires only a very small amount of money. For example, in Mexico or here too, in Mexico, if you want to invest in bonds, you only requires around like £5 or yes, like £5 or maybe $6 to start to invest. Even kids could invest in this kind of financial instruments. So you don't need to have a huge amount of money to invest. And what is the correct time to make an investment? I think that every time is the correct time, depending on what is your goal. Because, for example, if your goal is to buy something with your yield, maybe you need to invest in riskier securities. But if your goal is to invest, for example, to have to move your money, and because you don't want to have your money in your house and you need to move your money and you want to receive extra money, maybe you can invest wherever you want. Or maybe if you are waiting to track the market, you need to wait till a certain moment. For example, maybe when a stock, a share is very, very cheap, or or maybe you want to invest in, I don't know, maybe in Google or in Apple, and maybe you need to wait till the share shows a very good price to buy this proportion of the company. So basically, if in the first question, you can invest wherever you want, and in your second question, if you have a small amount of money, you can invest wherever you want. Okay, and we were discussing portfolio management. The portfolio management is the combination. With portfolio management, we are evaluating, or we are analyzing not only one security or one financial instrument. We are evaluating a group of investment. So this is one difference between investment analysis and portfolio management. In investment analysis, is a method in which we are investigating the trends of the market, but only with one security. But with portfolio management is the combination of different securities. Okay, Leticia, hi, a question to be answered later. What do you think about investing? Okay, we are going to discuss this cryptocurrency. But basically, I feel that cryptocurrency is a good option because now this is a trend. But personally, I feel that cryptocurrency is very risky, because I don't know if you have heard about the boom maybe in 2000 with the companies related to internet that suffered a crash because these companies was the boom in this moment in the 2000 more or less, and a lot of people invest in these companies, and at the end they broke up. So I feel that the same happens with cryptocurrency. Maybe now are very profitable because it's a trend, but we need to be very careful with this kind of investment, because in some of the countries, these cryptocurrency are not permitted. So maybe the trend is telling us, yes, the cryptocurrency is the boom today, but we need to be very careful, because normally these investments that are very attractive and very profitable also are very risky. So if you are thinking to invest in a cryptocurrency, my advice could be invest only a little amount of money to understand how cryptocurrency works. So don't invest all your money. So invest some money. Maybe you can think, okay, if I invest this money in cryptocurrency, I assume if I lose my money. So yes, you can invest, but be careful with this kind of investment. Okay, so in portfolio management, we have some professionals that are that could study what could be the most profitable combination of securities. And these managers act on behalf of the clients. So according to the profile of the client, the manager could create a combination of securities, a portfolio for the client, but all the time according to the profile of the client. One of the goals of the portfolio manager is increase the investment expected for the client, no? Because obviously the manager is working because he will receive a fee, and if the client increase the wealth, obviously the fee of the manager would be bigger. So this is one of the goals of the portfolio manager, increase the money of the client. And I would like that you remember this phrase: investment analysis is the key to a solid portfolio management strategy. So if the manager wants to create a very profitable portfolio, he or she needs to use investment analysis to create a very solid portfolio of investment for the client. Okay, this graphic helps to understand more the concept that we were reviewing. Portfolio management, we have here portfolio management is in which the manager is creating a combination of securities, and how this guy could create a very profitable combination through passive management or active management. This guide could be passive or active according to the kind of securities that this guy has in the portfolio, and both of this kind of management at the end use the investment analysis that we can have here. And investment analysis has different strategies. We are going to review bottom up, top down, fundamental, and technical. But in fact, we can combine these strategies. We can combine bottom up with top down, or bottom up with technical, but basically these are the strategies in investment analysis. So one part of the graphic is passive management. So what is passive management? So passive management is normally a management focused on long-term strategy. So the key of this management is track an index. If some stock exchange have this kind of index, and we are not investing in a proportion of a company, we are investing in an index, and we are like investing in an index. Maybe we have an index that the behavior of this index is very profitable, and we could say, okay, I'm going to invest in the index, not in a proportion of a company. We are investing in an index. For example, imagine China, no? That is a country that is growing a lot. China has an index, and maybe we can invest in this index because we know that China is growing. Or maybe we can invest in, I don't know, maybe in a Latin American country. For example, Brazil is one of the most important countries in Latin America. I feel that Mexico and Brazil are the most profitable countries in Latin America. So we can invest in an index of Brazil, or we can invest of an index of Mexico. But keep in mind that in this kind of management, we are investing in index. So for that reason, usually the manager normally the manager tracks the behavior of the index in the past to predict the future. No, if for example, if the manager noticed that for example, this index Nasdaq, the behavior of or in the past was increasing, so maybe the manager could think, okay, maybe the trend could be an increase, in the next 3 years, no? But in the 4th year, the trend says that the index is going down. So basically, the manager is studying all the past of the index and to predict the possible future, and to say to tell the investor, you can invest in this index, but then after 3 years is the perfect time to retire to your saving or your investment. And is designed to match the market performance, because basically we use the market to predict, no? So, and additionally, other key of the nature of the passive management manager is just on how well they track the target index. For example, if the manager could track very precisely the index, this manager would receive a extra fee or more fees, because the manager was very specific and very precise to track the behavior of the index. Okay, and what if we have the passive management? We have active management. So active management is more focused on not long term. It's more focused on medium or small term. And the goal of the active manager is to overpass the return of a passive benchmark portfolio. It means if passive management, I'm going to mute Romano, or could you mute yourself, Romano, please? Okay. So
I'm here.
Yes, please, if you can mute yourself, please. So the active management look for overpass the yields of the passive management, the passive management. So because, as you know, passive management is maybe only tracking the index and that's it. But active management look for find more option or more opportunities to invest. So is all the time active management is working. So for that reason, because active management all the time is working, active management looks for overpass the yields in passive management. So in this case, the active manager look for information, invest in insights, and use investment tools. So all the time this guy is working. But because this guy all the time, the active manager is all the time working, he or she could face difficulties. So maybe he needs to use more tools, or he needs to evaluate more scenarios. So this is, I wouldn't say that it's a disadvantage. Maybe it's some implicit in the way that the active manager used to work, no, to face difficulties. And this active management or active manager, the cost of this management is more expensive because all the time the manager is working. So obviously, because of the cost is bigger than in the active management, the investor could receive less money or less yields. But normally, this management, for that reason, this management takes a bigger risk, because obviously if we take more risk, we have more yields. And if we consider that the cost in the active management is bigger than in the passive, normally this management is a little bit more riskier than the passive management. So if we return to the graphic, we have discussed passive, that is in an index, based on an index, and active, that is based on the opportunities that the manager could find, because all the time this guy is working, and obviously because this guy is working, the cost of this management is more expensive, the risk is more expensive, but the yields are bigger than in the passive management. Now we are going to review these strategies. Okay. What is a bottom-up strategy? The bottom-up analysis focuses on an individual company. So this bottom-up is more focused on a small investor, because this strategy only pays attention in one company, only in one company. Let's say Walmart or a bank, or maybe, I don't know, maybe a specific restaurant. So bottom up, remember, is based on one specific company. Bottom up doesn't study the whole market, only one company. And is more for small investor, because obviously a small investor, they don't have the capacity to analyze a lot of companies. Maybe to start, the manager could use this bottom up strategy for a small investor. And what is top down is the opposite of bottom up. This strategy is for big investor, because this strategy requires to study the whole market, not only one company, the whole market, maybe the sector, maybe the combination of sectors, but at the end, top-down strategy studies the entire market. How is the behavior of the entire market? For that reason, this strategy is more focused on big investor. But we can have a combination of this. Maybe we can select, for example, if we remember that the concept of portfolio management, we can create a portfolio in which we can combine, in which the manager could combine the strategies. If we can combine the securities or the financial instrument in a portfolio, we can also combine the strategies. And other strategy is fundamental. Is a traditional method in which analyze the fair market value. Fair market value is the price that is basically the correct price in the market. So let's see, if you can see, for example, a share of a company, let's see, Google. And you or the manager determine that the price of the share is very fair, is according to the market, is not overvalued, is not overvalued, is not an overvaluated share, or maybe the value of the share has decreased. This is the time to buy the share, no? So, but fundamental, try to find the fair market value, that the value of the share are not overvalued, because if you want to invest and you buy this share that has extra price, is not worth it. So basically, fundamental strategy tracks the price of the share, and it recognizes when a share, when the price of a share is fair, when you can buy this share in a very good price, let's say. And technical, that this method is more focused on identifying the trading opportunities by observing the statistic of the stock market. So fundamental is based on the price, and technical is based on the statistics. So if the statistics says that the price of the share is going to increase, maybe we can buy this share now, because the statistics say that tomorrow the price of this share is going to increase. Or maybe if we have, for example, a share that we have bought, and the statistics say that the price is overvalued, we can sell today this share, because we will receive additional money for this share, probably because the price of this share that we have now, the price of this share, we can this price can decrease tomorrow. So it's a good time to sell this share now, and don't wait for tomorrow, because maybe tomorrow the price of the share that we have is going to decrease. So I wrote here some of technical methods. For example, we have momentum strategy, a contrarian investment strategy, those relying on moving average or rules and filters, and volume techniques. Basically, technical strategies could use these other techniques to evaluate the behavior of the statistic in the stock market. So, till now, you have any doubt before to go for the break? No? Okay. So let's go to the break. 10 minutes. We can come back at 12 to continue with this topic. So if you have some doubts, we can discuss in the second part of the lecture. Let's take the break. Now, we are going to see some examples how we can apply the investment analysis and the portfolio analysis, the passive and the active the active and passive management. So imagine we have two clients. We are the manager of a company, and we have different clients. So one client says that we have one client that is a woman of 20 years old, and
investment analysis.
Okay. We have two clients. One is a woman of 20 years old, and her income is her salary. This girl receives a salary every month, and she wants to invest because she has extra money. So even this girl told us that she could contribute extra money to the investment. And according to the profile of this girl, we could recommend, okay, you could be an aggressive investor. Why? Because maybe she is very young, she receives a salary every month, and she has the capacity to invest extra money of the investment. So basically, the recommendation that we can give her is that this girl could be an aggressive investor. It means that she can take more risk in a long term because she is very young, and she could invest probably in equity securities. We are going to review what is an equity security. And on the other hand, we have an investor that is a man of 70 years old, and the main income of this guy is his pension, and he is retired, and she is very worried about his stability because give me a minute. Sorry, guys. Share screen. Okay. Okay. So, and on the other hand, we have this guy of 70 years old. The income is his pension, and she is very worried about the stability of his finances because this guy is an old man, and he's not receiving, for example, as this woman that is receiving a salary, and maybe this woman could work in another, could work in another place, and because obviously because of the age, so basically one important thing to consider is that this guy is a retired guy, worried about the stability of in his money. And what would be a good recommendation for this investor? Maybe this investor needs to be a passive investor. It means that he needs to take less risk. And maybe because he's a passive investor, the good option for this guy is to invest in debt. We are going to review what is debt investment or debt securities. For example, government bonds. So the purpose of this example is to show you how we can recommend positive or benefits or a correct way to invest according to the profile of every investor. It means that maybe investment could be a good option for one investor, but for the other investor could be totally different. So for that reason, we need to analyze the profile of the investor. Okay, now to start the next topic, in which we are going to review what are the different kinds of securities, I would like that you watch this video to understand what is the stock market. Because in the previous slides, I used the term market, but what is the stock market? What is a thing, is a place, is a person? So I would like that you watch this video. And please pay attention, and obviously if you have any doubts, please let me know, type in the chat, or you can unmute yourselves to if you have any doubt or any comment about the video. Please let me know if you can hear, if you can hear the video. No audio. Okay, so again, can you tell me if you can hear the video now? No sound. Okay, so I'm going to send the link in the box, in the chat box, because I don't know why you cannot listen the video, but I'm going to share the link in the chat box, and please could you listen? And additionally, I'm going to play the video on the screen, and you can read the subtitles, or if you prefer, you can enter in the link, and please let me know when you finish to watch the video, please. Mhm. So basically, the video explains what is as a stock market, what is the stock market and how the stock market works. So a stock market is a place in which a lot of shares of the company are offered to the investors. So basically, investment is to buy this proportion of a company that the price of this share could increase or decrease the value of the company, and obviously increase the money of the investor or not. And because this market is very active and very dynamic, the prices could be very, very good or very, very bad. And it would represent wealth for the investor or a loss of the investor. So basically, market helps to the investor to have extra money, and for the company that sells the shares in this market helps to have money, receiving money from the investor. No, for example, if you want to initiate a project, the investor, no, money, and you have a company, you can offer a share of your company in a market that is the stock market, And a lot of investors could give you this money that you need for your company to initiate your project, but you need to give to this investor one proportion of your company. Basically, the market is the place in which the shares of a company or other instruments are trading. So are trade. So this is a stock market. Basically, is the place in which investors and companies that needs capital or money could trade the shares of the company. And if you have extra time and if you haven't watched the video, it's a very good video, very short, to understand the stock market. Now, let's see what is a security. The term security refers to a negotiable financial instrument that holds some type of monetary value, let's say a share of a company. And that we have three different types of securities. The main types of securities, obviously we have more securities, but the most common and the most basic securities are divided in three groups. The first is equity, that provides ownership rights to the holders. This is very common. Debt is basically a loan repaid with periodic payments. Debt works the same as a loan that we can receive from a bank. And we have hybrids, a combination of both equity and debt. In the case of equity securities, an equity securities represents ownership interests held by shareholders in an entity. This equity is the proportion of a company, and equity is divided in two groups: common and preferred stock. So when we talk about equity securities, holders need to know what kind of equity security, common or preferred. So remember, equity securities are divided in three groups: equity, debt, and hybrids. And equity, specifically equity, is equity in two groups more: common and preferred. So equity securities are financial assets that represent a shares of a corporation. We review this. The most prevalent type of equity is the common stock, but it doesn't mean that it's the only one that equity has. Equity has preferred stock too. Normally, in equity securities, the investor doesn't receive regular payments. They receive dividends. So this is one difference, for example, between equity and debt. That in equity, you will, if you have equity securities, you will receive a dividend. You won't receive a periodical payment. And in case of bankruptcy of the corporation, because remember, in equity, you have a part of the corporation. In the case of the bankruptcy of the corporation, of the company, you need to wait till the company pays, for example, to the employees or the suppliers, and you need to wait till the end in equity. These are the basic characteristics of equity securities. And these equity securities is divided into common stock and preferred stock. In common stock represent the ownership in a corporation and type of a stock in which most people invest. And in common stock, the profits that the investor receives is called a dividend. In this common stock, the owner of this share, of this proportion of the corporation, could take decision about the future of the company. It means in common stock, the investor has the right of voting. But in the uncommon stock is riskier than securities, that debt securities or preferred stock. Remember, preferred stock is the second group of equity securities. So in common stock is riskier than preferred stock. And now, what are the characteristics of preferred stock? Preferred stock, one of the characteristics is that you don't have, if you have a preferred stock in an equity security, you don't have the rights of voting. It means that you cannot take decision for the future of the company. In a liquidation, or in case of the bankruptcy of the company, you will be paid firstly than the investors that have common stock. So you don't have the right of voting in preferred stock, but you have the preference in terms of receiving dividends. Here, the dividends are usually higher than common stock, because common stock you have the rights of voting, but because you in preferred stock you don't have the right of voting, for that reason you as an investor or of a preferred stock, you will receive higher dividends or higher yields. And yes, basically preferred stock also gets priority over the common stock. So these are the two types of equity securities. So if we return to the previous slide, we review equity. That equity is the ownership or rights to holders, and equity is divided into common and preferred. And where these securities are traded in a market. Now let's check debt securities. Debt security represents borrowed money that must be repaid. It's like a loan. You give your money to a company that needs money, and you will receive a payment periodically with obviously part of the money that you have given to the company, and additionally interest. Basically, debt securities works as every loan that you could receive from a bank. They entitle the holder to regular payment of interest and repayment of principal, along with another stipulated contractual rights. Debt securities can be secured or unsecured. If they are secured, they might be contractually prioritized over the unsecured in the case of the bankruptcy. So if you remember the equity securities, we have common and preferred. And preferred would be you will receive your money first. That common stock is the same in debt securities. If you have a debt security secure, you will receive your money first than the owners of unsecured debt securities. So basically, it's the same division of the same way in equity securities, but in equity securities we call common and preferred, and in debt securities we call them secure or unsecured, to know what will be what investor will be paid firstly. So debt securities normally include government and corporate bonds, certificates of deposit, and collateralized securities. So if you heard about government bonds or this kind of securities, if you have heard about these securities, it means that these securities belong to debt securities. When we are talking about certificates of deposit, for example, we are talking about debt securities. And finally, hybrid securities, that is a combination of both types of securities, debt and equity. So for example, equity warrants. The terms of warrants is an option. For example, you have the option, this warrant is basically an option that you can buy. If you want to invest in a company, in a equity security, in preferred stock, and now the price is £1, and in the future maybe you don't know what price will be, what is the price of this stock in the future. So for that reason you can buy a warrant to say, okay, if the price of the share increase, I'm not going to buy the warrant, but I'm not going to buy the share, but if the price of the share decrease, I'm going to buy the share. So basically the equity warrant is to decide if in the future the price of the share changed, you could decide if you buy the share or if you don't buy the share. So basically this is an hybrid security, equity warrants, when you buy an option to buy the share in the future according to the behavior or the price in the share. This could be a hybrid security. And we have, for example, other that is convertible bonds, bonds that can be converted in share of common stock. You can, for example, start to investing in a debt security that in the future you can convert in an equity security. This is another example of hybrid securities. And preferred shares, that company stocks whose payments or interest, dividends, or another returns of capital can be prioritized over those of other shareholders. So, for example, if you have preferred shares, you will be the first to be paid. But maybe if you want to take an extra risk, you can say, okay, I'm not going to take my place in the list. I'm going to take maybe the second place, but I'm going to receive extra money. So I leave my place number 1 to be paid, to take the place number 2, but I'm going to receive more money or more yields. So these are basically the example to understand hybrid securities. And this is a balance sheet in which we can find the investment that we can do. For example, imagine that this is the balance sheet of the company in which we are investing. Debt securities, as you know, or I don't know if you can analyze. No, I don't know if you can understand this balance sheet, but basically by balance sheet, in this part, we have all the assets. This part, we have all the liabilities. And in this part, we have the equity. So assets is equal to liabilities plus equity. So if we move something here, we need to move something there. But imagine that this is the balance sheet of the company in which we are investing. If we invest in debt securities, the securities will be here in the liabilities side. If we invest in equity, equity will be here in shareholders' equity. So this is a very useful way to understand where the investment could be reflected in a balance sheet. Basically, this is the balance sheet of the company. Liabilities are here. All the securities, the debt securities are here, and the equity securities are in this part. And to finish this topic, and the entity that creates securities for sale is known as the issuer. So the company, for example, if we want to buy a share of a company, the company in which this company is called issuer, and the person or the people that buy this share is called investor. Generally, securities represent an investment and means by which municipalities, companies, and other commercial enterprises can raise capital. So trading with securities is important because some companies or governments are looking for capital, and probably they could go for a bank and ask for a loan. But a most dynamic and maybe convenient way to raise capital is to issue debt, or to invite investor to give their money, and the company or the government could use this money, and for the investor is convenient because the investor will receive interest. So this is a basic graphic how the securities work. For example, we have here an investor, and this investor is lending money to these companies or governments because these companies or governments maybe are looking for to reach a goal. Maybe the government wants to create a new subway in the city, but the government doesn't have money. So for that reason, they go to the market and say, okay, I'm going to sell not the proportion of my company, because at the end the government is not a company. I'm going to sell debt securities in order to receive money of the investor, in order to create this new subway that my city needs. So if I'm going to receive money from the investor, I'm going to repay this money plus interest in a time. It could be a short term or it could be a long term, depending on the type of security. So remember, normally debt securities are in short term or for investors that are not very aggressive. And in case of short term, we have the equity securities, or maybe we can aim to find investor with an aggressive profile. So, but basically this is a process in which we can understand the trading of securities. And where securities are traded, the securities are traded in primary market or a secondary market. A primary market, we call primary market, in which if we can analyze a company, and this company wants to have money, because this company is looking for a very specific purpose. So the first offer that this company put in a market, this market is called primary market, because it's the first offer that the company is doing to sell part of the company, or to sell its shares. So for that reason, in this market is called primary. And because in primary market we can find the company, it means the direct issuer, and the investors. So in the place in which we can find the issuer and the investor is called primary market. What is the difference with secondary market? In secondary market, the participant of these secondary markets are only investors. For example, if I am investor that I have some debt securities, let's see, I have one share of Apple, and you have one share of Google, we can sell. I can sell my share of Apple, and you can sell your share on Google, but we don't have a direct contact with the issuer of Apple or Google. I mean, it means that the trading that is done in this secondary market is only through investor, not with the issuer. It's only investor, and here is issuer with investor, and it's the first offer that the issuer is doing. So this is the difference between primary market and secondary market. And let me check the time. So we have 5 minutes more to see if you have any doubts about this topic. So do you have any doubts about this topic? Is clear? Do you need that we analyze a specific topic that you didn't understand, or do you have any comment? When do you use Elliott wave principles? I haven't heard about Elliott wave principles. But I feel that it's a theory in technical analysis used to describe price movement in the financial markets. Maybe you can use